Alright, so in this video, I wanted to talk about how to exercise a call option or how to exercise a put option with Questrade. So if you bought an option, if you bought a call option, or if you bought a put option, you could exercise it, because basically the definition of a call option or a put option, well, first, the definition of a call option is the right, but not the obligation, to buy 100 shares of the underlying stock at the strike price before expiry date. The definition of a put option is you have the right, but not the obligation, to sell 100 shares of the underlying at a particular strike price. So exercising an option relates to option buyers, people who buy options, not if you sell an option. If you sell a call option or if you sell a put option, you can't exercise it. You're the seller. So it only applies to buyers of options. So in Questrade, not in the trade section, but in the account section, the account management section, if you go to requests here, you'll see exercise an option. So if you click on exercise an option, now I'm going to tell you how to exercise an option, but I'm also going to say why I don't think it's a good idea to exercise an option and how there is an alternative to exercising an option. All right, so once you click on exercise an option, you choose your account over here, the account number where the option is sitting. And then you're going to choose the action here if you're exercising or expire worthless. So if you're exercising an option, you're going to click exercise. And then you're going to choose the quantity. So how many options do you have? 1, 2, 3. And then you're going to enter the option symbol, which they have an example at the bottom here. Usually you'll find this next to your option. Then you're going to choose the underlying security. So if it's a call option on Tesla, you're going to put TSLA. Then you're going to choose the expiry, the month expiry of the call option in question, or the put option in question. You're going to put the expiry year as well. So basically, this should be the date of the expiry, but they're breaking it up in month and expiry. And then here you mention whether it's a call option or a put option. And here you put the strike price of your option. So it allows them to locate the option in question. So if you have a call option that you bought and you want to exercise it, what's going to end up happening is you're going to end up buying 100 shares of that stock at the strike price chosen. So if the strike price, for example, is, 500, and you decide to exercise your call option, you're going to need $50,000 in your account to be able to buy 100 shares at a 500 strike, 100 times 500. If it's a put option, if you've got a put option instead that you bought and you want to exercise it, that means you're selling your shares. That means you already have 100 shares of the stock and you're selling it. So you're going to end up selling it at the strike price that you bought the put option at. That means let's say you bought the 500 strike put option. That means you're going to receive $50,000 into your account because you're selling the 500 put. You're receiving 500 per share price, and you're going to lose your shares. So the shares that you had, they're going to get sold, they're going to get removed from your account. Now, here's why I don't think it's a good idea to exercise options, and I'll give you my opinion. So first of all, with Questrade, there's a processing fee of $25 to exercise a call or put option. So instead of exercising the option and paying that fee, here's a better way to exercise an option. So I'm going to go to the trading window, trading section. I'm just going to look up the price of a let's look up Tesla. I'm just giving an example here. So let's look up Tesla, and let's look up I have to go under options. So let's look up, July 16, let's say the 600 call. So you could see the last traded price for this Tesla call at a 600 strike is 41.65. So let's say you bought the call option at a 600 strike. You paid $41, and whatever you paid, doesn't matter what you paid. That's not the point. Let's say you paid $30. And now now your call option is worth $41.65. For some reason you want to exercise the call option. That means you want to end up owning 100 shares at a 600 strike. So that's $60,000 that you have to spend. Thinking that, Tesla still has a lot of room to the upside. So I want to buy the shares at 600 and hold on to it and just let the stock fly. So if you exercise your call option, whatever you paid for that call option is lost. You're not getting that back. you're going to end up owning 100 shares at a 600 strike. So that's $60,000 that you're going to have to pay to own shares at 600 strike. Plus, you're going to have to pay $25 fee for exercising that call option. But what you can do instead is if you want to own shares, if you really want to own shares, instead of exercising your call option, you could just sell your call option. So let's say you bought your call option for 30, you could sell it right now for 41.65 and then go ahead and buy the stock on the market, whatever it's trading at. So whatever extra you'll be paying between the strike price and the current market price, you're going to make it up by selling the call option. Plus, the call option most likely still has a bit of extrinsic value, a bit of time value. So by selling it, you get to keep that extrinsic value. You get to make that extrinsic value as profit instead of throwing it away. When you exercise your call option, you're throwing away whatever you paid for the call premium, and whatever extrinsic value is left in the call premium, you're letting it go. So let me just look at an in the money strike instead. So let's say you had bought the 580 call. Let's say you paid $40 for it. We could see that right now it's trading for $52. If you exercise that call option, the 580 call option, you're gonna end up with 100 shares at a 580 strike, and that $40 that you paid is gone. So let's use numbers here just to portray the example. So let's say you bought a call option, the 580 strike, you paid $40 for it, for example. So that's 0 minus 40, right, times 100. So that's $4,000 that came out of your account. And then you decide, okay, I think Tesla is going to $1,000. So I want to own shares. I want to buy shares. Okay, I'm going to exercise my call option to own shares, 100 shares at a 580 strike. So that means I'm going to spend $58,000. That's coming out of my account. So I'm going to click minus 58 because that's how much money is coming out of my account. So now I've spent $62,000 to own Tesla shares at 580 strike. But so basically it's as if I paid $620. It's as if I owned Tesla at a $620 price. But I'm okay with that because my assumption is Tesla's going to 1,000, so I wanna own the shares. So remember that number, $62,000. So what you can do instead of exercising an option, plus you would have paid the $25 to exercise. So instead of exercising your call option, let's say you had bought your call option for $40. So times 100, that's 4,000. And right now that call option is trading for $52. So you could sell it for $52, right? So that's $5,200. And then you could go ahead and buy Tesla at the current market price, which is $5.99. So that would cost you 100 shares at $5.99. So instead of buying it at $5.80, you're buying it at $5.99. But let's see what happens. So you would be spending $5,900. So now your total cost for the trade is $58,700. So instead of buying it at a 580, instead of owning it at 580, you're actually owning it at 58,700, which is better than 62,000. So you're owning it at 587 instead of owning it at $620. So $620 is what would have happened if you exercise the call option. $587 is if you sold the call option and bought the shares right away at the current market price. So yeah, so you're disappointed probably because I wanted to buy the shares at 580 instead of 599. Yes, you paid more for the shares, but you compensated for it by selling your call option that had extrinsic value in it. So that profit in the call option compensated for the extra that you'll be paying for the shares. So 599 minus 580, but you're making an extra profit by selling your call option instead. Now this is an extreme example because it is a July 16 expiry, so there's a lot of extrinsic value left. So let's look at a closer example. Let's look at June 11th example, and let's look at a strike that's more in the money. So let's look at let's look at the 550 strike over here, okay? And assuming that this is accurate, so yeah, this looks like a better example. So I'm looking at the 550 strike. So let's say you bought the 550 call option and you paid, I don't know, let's say you paid $40 again. So you paid $40 for it. So if you wanted to exercise that call option because you want to own shares of Tesla at 550, because you're seeing it right now at 599 and you think it's going to go to 1,000. Okay, so let me grab some Tesla shares at 550. I paid for it, right? I bought a call option that gives me the right to buy shares of Tesla at 550. So if I do that, remember I paid $40 initially for my call option, so that's minus 4,000. Plus I'm gonna buy shares at 550 by exercising my call option, so that's 55,000. So now I've spent 59,000. So it's as if I paid $590 per share for Tesla. But as you can see on the market right now, it's worth $5.99. So if I want, I could actually sell it right away and make a profit of $9 per share. But I wanna keep it long term. So remember this number, $5.90. If I exercise, my cost on Tesla, my cost for Tesla is $5.90 per share, plus $25 assignment fee or exercise fee, sorry. But now let's say I don't exercise and I decide just to sell my call option on the market and buy the shares at $5.99. So initially I started off by, I paid $4,000 to buy the call option. So I'm down $4,000. And then instead of exercising, I'm going to sell my call option, which is now worth 52.82. So that's plus 52.82. So now I'm actually up 12.82. But then I'm going to go ahead and buy 100 shares of Tesla at the current market price. So that's minus 59900. So now I've spent, my cost is 58,618. So that means my cost per share is $586. While before my cost per share was $590. So the difference is the extrinsic value that was left in the call option that I was able to collect by selling it as opposed to exercising it. So 590 minus 586, $4. That's time value left in the call option that I got to collect by selling it on the market, and then I go ahead and buy the shares at 599. So yes, I pay more for the shares, but it's compensated by selling the call option for a profit and with some time value remaining as well. Now, in terms of taxes, you're going to end up owning shares. Instead of owning shares at 550, your cost basis, instead of your cost basis being 550, your cost basis is going to be 599. So in the future, when you sell it, you're going to have a smaller gain because your cost basis is higher. But you're going to have a gain, a capital gain right now when you sell your call option, because you bought your call option for 40 and you're selling it for 52.82. So you're going to make a gain right now by selling your call option, but you're going to save it in the future when you sell your Tesla shares because your cost basis is higher. So same thing on the put side. I'm going to look at the 620 put. Remember, put is the right to sell your shares. So let's say I already own shares. Let's say I bought Tesla at an $800 price, and I bought a put option at a 620. Well, let's not use 800. Let me just use 700. So let's say I bought Tesla at 700. So that means $70,000 came out of my account, and I bought a put option at a 620 strike for protection, so that if Tesla drops below 620, well, my lowest selling price is 620. So even if it drops to 400, I can still sell my shares at a 620 strike. But obviously, to get that protection, to get that insurance, I had to pay a premium. So let's say I bought the put option, I don't know, for $20. Okay, so I bought the put option for $20, and right now it's trading for $28. So the last traded price here is $28, and Tesla is actually trading for 600. So, or the current market price of Tesla is $599. So I want to exercise my put option because I want to sell Tesla at 620. Because I don't want to lose an extra $20 per share. So I want to exercise my put option and sell my shares at 620. So if you exercise your put option, so remember, you bought shares at 70,000. You also bought the put option for $20, so that's minus 2,000. But then you're going to end up selling your shares for $620, so that's $62,000 that comes in. So now you're down. You've capped your loss to $10,000 or $100 per share. Now, what happens if you, instead of exercising the put option, what if you just sell your put option and then sell your shares at whatever market price it's trading at? So remember, I paid $700 times 100, so that's $70,000. And then I paid $2,000 for the put option. But then my put option is worth $28. So that means I'm going to collect $28.10. That's going to come into my account. And then I'm going to go ahead and sell the shares at the current market price, which is $5.99. So plus $5.99. So now my loss is $9,290 instead of being $10,000 over here. So that difference is, once again, time value that's still available in the put option that I'm selling. So all I'm saying is, instead of exercising an option, you have another option or another choice. You could sell your options on the market and either buy right away. In the case of a call option, you could buy shares right away, current market price, or you could sell your shares at the current market price in the case of a put option that you bought. So if you bought a call option, instead of exercising, you could simply just sell your call option plus, I'm going to say plus because you could do it at the same time, sell your call option plus buy 100 shares right away of the current market price. And then in the case of a put option that you bought, so instead of exercising, you could sell your put option again, plus sell 100 shares at the current market price. So this is assuming that you already own 100 shares of the underlying. So just keep in mind the tax implications. If you sell your option, you'll make a capital gain on the option, but your cost basis on your shares will be higher. And in the case of a put option, you're actually selling your shares for even less. So you're getting more of a loss, which will compensate against future capital gains. So you're generating a bigger loss by selling shares lower than the strike price. So in the example of Tesla, we said that we bought it for 700, and instead of selling at our 620 strike, we end up selling at the current market price of $5.99. So you're generating a bigger loss by selling the current shares at the current market price instead of exercising your put option at a 620 strike. All right, so if you have any questions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.